Hi, we're here today to talk about Class 7 if you're in the Monday, Wednesday, Friday class schedule, and we're going to talk about class number 5 if you're on the Tuesday, Thursday schedule. So we're in the end of Chapter 2. We've learned a lot of accounting so far. It's really pretty amazing. If you've been keeping up, you actually already know how to analyze, journalize, and post transactions to the ledger. So that's pretty much what you need to be able to do to keep track of accounting transactions at your company. Of course, the point of keeping track of these transactions, analyzing them, posting them as a debit or credit, keeping up with the balances, is so that you can report out and make this information useful to users. So for the end of the chapter, we're going to learn about how to create a trial balance, which is going to let us start to prepare our financial statements. So obviously the point of tracking all these transactions is people are going to get reports called financial statements. And we need to start thinking about how we're going to prepare those. So this trial balance is the first step towards that. All right, what is the trial balance? A trial balance is prepared after the journal entries have been posted to the ledger. The trial balance is a summary of all the accounts with their balances. The trial balance lists the assets, liabilities, and equity in that order. The purpose of the trial balance is to check whether or not debits equal the credits. So let's take a look at the example trial balance we have here on the PowerPoint or in your book if you're following along with using the book. A trial balance is going to summarize everything we've done so far. So if you think about what we've done so far in accounting, we've had transactions occurred. Something was purchased, something was sold, some work was done and salaries accrued. Something occurred and we recorded something. So we first record it in the journal in chronological order. That's the journal, is chronological order, and you list the accounts, the two accounts affected, and debit or credit, and you just go in chronological order. Then at some point, we stopped and we took those journal entries and we posted them to the ledger. So in our examples, we used those T accounts to be representative of a ledger. And you just went through the journal, and for every account, whether it was a debit or credit, you posted it to the proper account. So if it was a cash debit, you posted it to the cash account as a debit. If it was a liability of some kind, an account payable credit that increased a liability, you posted account payable credit. So once you posted everything, now you've got your individual T accounts. So you could, if you want, go to the cash account and look and say, oh, what's the balance in cash? Or you could go to accounts payable and look and go, what's the balance of my accounts payable? And that's great, and it's wonderful to be able to do that. But most people want a summary of all those accounts. So we use the trial balance for that. And plus we want to make sure we've been doing all our accounting entries right. So if we've been posting an equal amount of debits and credits, then our trial balance should balance out to be an equal number when we total them up. Debits should equal credits. So to prepare a trial balance in good form, you tell what company it's for at the top, you write what kind of report you're making, so in this case it's a trial balance, and the date. So this is as of December 31st, 2016. So that's really important when you think about it as we start preparing our financial statements and reports. Your report readers, your users of information, need to know what they're looking at. So that's why we always say in good form, and we require a heading, right? Because sometimes you can imagine if you're an investor and you're investing in stocks, you might look at a lot of different companies' information. So you'd want to know right off the bat, what company am I looking for? So we put that company. Then you want to know, well, what report is this? Is this an income statement? Am I looking at a trial balance? Is it quarterly? What is it? So we always put the title of the report and the date. So that way people can know what they're looking at. So when I say prepare a financial statement, I was going to say prepare an income statement, prepare a trial balance. When I say in good form, I mean put the title up there so we know what it is. All right, so you prepare it in good form by putting the title, and then you just list the accounts in their order. You know, typically in a ledger, the accounts are in a certain order. They come assets first, liabilities second, equity accounts next, and underneath equity are the dividends, revenues, and expenses. And that's how we got it here. Typically, the assets are listed in terms of the most liquid. In other words, what is most readily converted to cash, most liquid to least liquid, and the liabilities, most current to least current. So there's sort of an order that things are listed in, and typically your ledger's accounts are set up in that order. So you don't have to think about it, but you may have to because you're just now learning what order things go in. So remember on your trial balance, list your assets first, liabilities second, equity accounts next, revenues, and expenses. So when you do your trial balance, you set them up in terms of a debit column and a credit column. And you may recall that we've talked about how accounts have a normal balance, right? We talked about whatever increases the balance is the normal balance. Well, if you look, you'll see that cash, well, all your assets really, cash and accounts receivable and office supplies, those all increase with debits. That's their normal balance. So you see we're listing them in the debit column, right? That's why it's important to know what a normal balance would be, because normally they would be in the debit column, all those assets. We know that liabilities and equity increase with credits. Therefore, the accounts that increase liabilities and increase equity go in the credit column, the right-hand column. Anything that reduces equity, like expenses or dividends, goes in the debit column. So it's important to make sure that you're listing things in their proper order. And at the end of it all, you're putting them in the correct column with their normal balance, and you add up each column, and hopefully, if you did it right, your debits equal your credits, and that tells you you did, and maybe, all right, you could still have an error somewhere. I'm not going to say you didn't, but you know, you feel more comfortable about your transactions. You feel like you maybe did them okay, so you balanced. So it's what's called balance, a trial balance. We're testing it out like a trial. We're testing it, testing the balance. It's called a trial balance. So make sure you memorize this order and what accounts get debits and what accounts get credits. Now, we do these trial balances in order to help us prepare the financial statements. Now, we're going to get into this a lot more in the next chapter, but it's pretty important that you understand what accounts go on what financial statements and what the financial statements are. So, in addition to verifying the equality of debits and credits, the trial balance is used to prepare the financial statements. The account balances are taken directly from the trial balance to prepare the income statement, statement of retained earnings, and balance sheet. So if you look back here, you'll see that we've taken the revenues and the expenses right off of this trial balance, and I put them here, right? Revenues minus expenses equal net income. And again, here is that in good form, right? Here it says what company, which financial statement. In this case, it's income statement. An income statement, what period of time are we tracking the revenues and expenses for? Well, we're tracking them for the 2 months ended December 31st, 2016. So this is a very simple income statement. Revenues minus expenses equal net income. Then, and it's always important, this is where we're going to start to learn, it's important to prepare these in this specific order. Once we've prepared our income statement, we know our net income. And that is what increases retained earnings. So remember, retained earnings are what belong to the owners. They're part of the equity. And so they increase when we earn revenue and decrease when we pay out expenses. So retained earnings increase with our net income. So one of the financial statements we create, the statement of retained earnings, right? Because if you were an owner, you'd want to know how much your retained earnings went up, right? So here again, good form, the company name, the statement name, the period of time. And here it starts with your retained earnings at the beginning, plus your net income, minus any dividends we paid out. Remember, dividends kind of work like expenses. They're not expenses, but they work like expenses in that they decrease retained earnings. So take out those dividends, and now we have our new retained earnings. All right? Well, we need that to prepare our new balance sheet, because the difference, all the changes in the assets, liabilities, are what created this net income. So it needs to come down and become our new retained earnings. So we take revenues and expenses from that trial balance. We move the net income over to statement of retained earnings. We got the old statement of retained earnings from the trial balance. We got our new retained earnings, and we plug it in our balance sheet, and all the rest of these numbers, cash, receivables, all the liabilities, all the rest of those numbers came from this trial balance. We just moved them over. The only one that didn't come from the trial balance is our new retained earnings. And we balance. You can see that the assets totaled up equal the liabilities, and the owner's equity totaled up. So our accounting equation has stayed in balance all throughout that period. So this is super important. We're going to have to start preparing financial statements. This is the reason we do all the transactions. So make sure you start to comprehend financial statements, income statement, use the income to prepare the statement of retained earnings, use the new retained earnings to prepare the balance sheet. But all these other numbers, the totals of the accounts, came from that trial balance that we had to prepare. All right. Now, sadly, we're not always perfect. So, I just want to give you a few hints, and maybe these will be helpful. Like, let's say on an exam you're doing a trial balance and it doesn't balance. What can you do to figure out where you could have gone wrong? Of course, always double check your math, make sure you added right. But there's some little tricks of the trade so that when your debits don't equal your credits, there's an error, right? Something happened. Something got posted incorrectly. That's what that means. You posted the wrong dollar amount. You posted a debit as a credit. Something happened wrong, and so now your debits and credits are out of balance on your trial balance. So here's a few little techniques you can use that can help you. First of all, balance errors. If the debits and credits are not equal, an error exists. Balance errors can be located by performing a search on the trial balance for any missing accounts. So just scan. We call that scanning. When we do an audit, scan, look for anything that's missing. Divide the difference between the total debits and credits by 2 locates doubling errors, which occur when a debit is treated as a credit or vice versa. So what that means is, let's suppose that the difference between your debits and credits, so let's look back here at this trial balance. Let's suppose you do your trial balance and this number turns out to be 100,000 and this number turns out to be 120,000, right? So you got a difference of 20,000. Divide it by 2, and that means you could possibly have a $10,000 doubling error, which means you posted something as a debit that should have been a credit, or vice versa. So basically, you've doubled your debits or double your credits, whichever one you posted it wrong as. So then, once you say, oh, I might have, when you divide it by 2 and you come up with 10,000, you say, well, let me go back and look for any $10,000 transactions. And you go back and look for $10,000 transactions. You say, oh, look, there was a purchase of office supplies, and I put them down as 2 debits. I debited cash and I debited office supplies when I should have credited cash and debited office, right? So that's what that means. Doubling error means you posted something as a debit and a credit, so you kind of doubled it. And to find that error, you divide by 2 and look for something in that amount. Another error that could happen is a transposition error, e.g. when an amount was recorded as 2,100 instead of 1,200, may exist when there is an out of balance error. If the result is evenly divisible by 9. Evenly divisible by 9. So if on this trial balance you had 120,000 and you had you had a difference that was divisible by 9, you would go ahead and look for that number. So let's imagine that the difference between these two was $27, right? $27. That's evenly divisible by 9. So then you go back through and you look through debits and credits. You say, well, is there something that I wrote down as 1,200 instead of 2,100? Or did I slide? Which a slide is when you put the decimal in the wrong place. So a slide would be where you record 1,000 instead of 100. So if you think about it, if you record 1,000 instead of 100, you've got a $900 difference. That's evenly divisible by 9. So you go and you look for a slide or a transposition, flipped numbers. And those are just some little hints. I tend to scan and see if anything's missing. Sometimes you'll see double entries, like, oh my gosh. Sometimes if you look back through your T accounts, you'll see something on the wrong side. A debit is, because think about expenses. Pretty much expenses are just always going to increase, so they'll always be debits. But suppose you wrote one down as a credit. That would be easy to spot, right? Because there just should not really be a credit expense. So if you don't balance on your trial balance, it's okay, don't freak out. There's little ways to figure that out. And 1 is divided by 2. Look for a difference in that amount where you double posted. 1 is divided by 9. And look for transpositions or slides. All right. Final learning objective for Chapter 2. The debt ratio. All right, so you may recall from Chapter 1 we learned about a ratio. Every chapter we're going to learn a new way of thinking about financial statements. We use ratios to help us compare numbers to each other. Right? Just one number by itself doesn't make much sense. If I told you my net income was $100,000, that might sound pretty good. But what if I had spent $500 million to make that? What if last year my net income was $800,000 and now it's $100,000? Right? So numbers all by themselves don't necessarily mean a lot. So we start thinking about different ways to analyze financial statements. And using these different ratios is how we do that. So here's one example that investors and other people think about companies. The debt ratio is used to evaluate a business's ability to pay its debts. The debt ratio shows the proportion of assets financed with debts. Companies with a high percentage of liability are at a greater risk of default, meaning they would be unable to pay their creditors. The formula to calculate debt ratio is total liabilities divided by total assets. So, very simple ratio, just add up all the liabilities, add up all the assets, divide liabilities by assets. So if liabilities are a lot bigger than assets, right, you're going to get a bigger number, right? So the bigger liabilities are, the smaller assets are, the bigger the number you're going to get. So the higher the number, the worse it is for that company. It means they don't have a lot of assets compared to their debts. So, that can mean bankruptcy, not a going concern. It's really something to think about. So we want to make sure that a company is healthy, so we use this. And it also helps us compare to other companies. Suppose you had a corporation that you were comparing to another corporation. Suppose you're comparing Coke and Pepsi. And they had about the same amount of sales, they had about the same amount of expenses, they had about the same amount of net income, but one had a really high debt ratio compared to the other. That might change the way you think about it. So, important to learn these, because that's really the point. I mean, yes, it's great that we learn how to track the transactions using our debits and our credits, and it's great that we post them, it's great that we prepare a trial balance and financial statements, but people will use those financial statements. That's the point, is what information do we get from those financial statements? And just one way to think about them, there's many ways, as we'll learn, one way to think about financials is in terms of the debt ratio. All right, so that's it for chapter 2. The next thing in class, you're going to come to class with your homework. So for homework, bring S2-8 and S2-9. And in class, we're going to work problem 229A on page 101. So you might want to bring this to work out that problem because it's kind of a lengthy one. It's kind of like one of those problems that brings everything together. We're going to do that in class together. All right. See you in class. Have a great one.